All right, welcome back to another episode of the Tim and Tim Show every Tuesday at 10 a.m. Eastern Time, live and making moves in multifamily Facebook group. Tim Vest, good to see you, man. Love to see our logo on your shirt and on your TV in the background. We're making moves in 2026, and we're going to talk about how. I think that's probably a good way. We talked a lot about how our business processes have changed. We've talked a lot about our investment thesis has changed, and we're going to talk about this week how we stay disciplined, right? How we stay disciplined to make sure that we're making good choices. And a lot of it's been learned by experience over the last 12 to 18 months. So, it's been interesting, and I'm not gonna lie, maybe a little disheartening because it seems to be harder to find some deals. But I do know that when we do get a deal that hits, I mean, Tim, we were looking at a deal this past weekend, and I said, "Hey, man, month one, debt service is covered with distribution to the investors." That sounds real tasty. Let me get some more of those deals. And I am committed to being patient, and I'm committed to being disciplined in my underwriting and sticking to my guns on the principles that we've talked about pretty regularly now and what we are going to provide to our investors. And last tidbit before, Tim, you start your little spiel here is I've seen an email recently from two other very well-known individuals about how their investment model has changed, and they are starting to acquire property again and using the exact same underwriting process, mindset, and thesis. So I know I'm not too far off my rocker here because this time we're going to ride the wave the whole time with our investment thesis and really build a super strong portfolio in the Carolinas. And my goal is to be known as, the LIHTC investment opportunities, the affordable housing investment opportunities in the Carolinas. So with that, Tim, you're up.
I don't have a little spiel,
but
what I do have is
a bit of wisdom here.
Yeah, what I do have is guys, over the last year and a half, right? I think we've all just learned a lot of things. And Tim, I think you mentioned one that was, it needs to cash flow from day one, and I would add one little piece to that too is, especially with rents the way they're going these days, staying flat, and government housing isn't paying on time like they used to. It's not the sure payment that it used to be, for different reasons. But there's a lot of reasons right now that I'm like, hey, if I'm going to take a value add deal, then I want it to be a heavy renovation value add deal that is not predicated on, hey, if I do this, I can raise rents $300 on my property, right? And the reason I say that is because, Tim and I have done a number of deals where, we look at it and the seller says it or the market says it or whatever. It's like, hey, it's a light lift, and you're going to be able to go get, rents $300 more than the in-place rents today. Well, guess what? This market has shown that rents have pulled back or stayed flat, and you go do that light lift, and all of a sudden you're like, oh, I can actually get that rent right now. So like Tim's saying, for deals like that, there needs to be cash flow day one. And if I'm looking at a value add renovation deal, then I will take it that, hey, once I do this, I can get the rents that it was getting before, right?
Yes.
I'm just stabilizing and taking care of deferred maintenance, basically, in order to make sure I can keep getting that rent, right?
That's a beautiful way to say that. I mean, because you and I have that conversation all the time when we're underwriting deals. And I'm trying to underwrite a deal, and I'm saying, okay, I'm being told that my pro forma rent is $1,000, but all my other units are $850. Okay, well, what renovations did you do to get to $1,000? And I'm going to budget for that and get all of my units up to $1,000. And then if somebody says, well, no, you should underwrite to $1,100. Why? You're not getting it. And I don't think I'm going to get it. And that's one of my bullet points that I have here is what smart investors are not doing is banking on appreciation and rent growth for the next 1 to 2 years.
Yep.
And deep down in my heart, I know and believe that rents are dropping, right? I mean, we saw thanks for
Oh,
appreciate that.
thanks,
Morning, Dennis
Durbin.
and Joe. Uh, um, fair market rents in Charlotte, they got posted and it was a 6.5% decrease in fair market rent for
Mhm.
2026. That could continue next year. That could
Yeah.
stay flat next year. Um, Everything else that I've been reading and paying attention to is that the supply is being absorbed faster than anybody had anticipated, at least in the Carolina market, which obviously is where we focus. And that leads me to believe that if rents are flat for the next year, that the year after that, which would be 2028, is when you'll start to see some rent growth and appreciation again. And really,
Oh, you
from there,
that's it.
oh,
I was
go
gonna
ahead.
I had a question for you, but you're already going there. Go ahead.
Yeah, 2028. I've been saying 2029 into 2030, but with the absorption numbers being published recently about how fast they're being absorbed in the Carolinas to this day, even during the slowest moving period of the year, which is the end of Q4. I think they pushed that timeline up about 12,
Yeah.
maybe 18 months, which is a good thing for us as we continue to refinance into 5-year debt. But on new acquisitions, and if you take away anything from this, on new acquisitions, you need to make sure that your in place cash flow today covers your debt service. And if it doesn't, I would make sure that you're covering at least 2 years of debt service in the bank as a reserve
Yeah.
balance.
Yep.
And that's part what one of my other bullet points of what discipline outperforms genius here is discipline is making sure that your property is adequately reserved to cover taxes, insurance, unexpected capex. I mean, gosh, we have been slapped across the face with some stuff I had never even considered before. Every day is a new problem.
Yeah. Oh, geez.
Um,
Yeah.
so Curbins, hopefully I'm saying that Curbins. I'll bring it up on the screen actually. Oh, I forgot to say. How do you mitigate pushback from tenants for rent increases? That's a really great question. So I'll answer that in two answers. We do affordable housing, which is it's LIHTC, low income housing tax credit. Every year, the government does an analysis on the fair market rent, or the average market rents and the average median income. We are then given what our rents can be for that year. Sometimes they go up, sometimes they go down. When we are working with affordable properties, there really isn't any pushback. I mean, there is. Oh, so let me preface that. There's always going to be some level of pushback because people never want their rent increased, right?
Yeah.
But our defense is, hey, this is a study that's done by the local government to make sure that our rents are adequate for affordable standards, right? And if you qualify to live in a 30%, a 50%, or 60% unit, this is what your rent needs to be. And if you don't like that, you can go find somewhere else to live. And if they do want to do that, they're either going to find another low income property that's charging literally the same amount of rent as we are, or two, they're going to move into a slum that nobody's taking care of it and the rent is $200-300 a month less. But I mean, it is what it is, right? I mean, that's kind of our two things there. Would you agree or disagree there?
Yeah, I mean, at the end of the day, currency, I agree with that. But at the end of the day, Curbins, I don't think you're ever going to mitigate the pushback, right? Because
No.
how do you mitigate the pushback? I mean, you're not. I mean, nobody ever likes paying more for the same thing, right? And I
Correct.
think that's kind of a key a little bit, right? Is we work with our tenants to kind of help them understand maybe they're not paying more for the same thing. For example, one of our strategies when someone says $200 more a month for the same place I've been living in for the last 5 years. Okay, cool. How about some new appliances, right?
Yeah.
Um,
Oh, that's a
yeah.
really good. Yeah, we do. If somebody's asking for something like that, if they've been a good resident, they've been paying on
Yep.
time, they've
Yep.
been in the property longer than what we've owned it. Yeah, we'll go in. We'll say, yeah, we never do flooring, right? Because everybody, the stuff has to be completely removed from the unit. It's really just not reasonable to replace flooring. But we can do paint, we can do countertops, we can do appliances, we can do some light stuff in the
Yeah.
unit to renovate it and bring it up to, more renovated standards or recent standards to kind of support that $200 rent increase. And generally, we don't want to take on vacancy, right? Vacancy costs you more money because you got to renovate the unit entirely. So it is a bit of a gray area, a bit of a back and forth. It kind of depends on the resident. It depends on your business plan. It depends on your debt service. It depends on a lot of different things, right? So you have to kind of look at all of those points. But uh,
Yeah.
generally speaking, for a live tech property, you're not going to find rents any different anywhere else unless you're downgrading where
Yep.
you're going to live. In a market rate property, people can come and go and move wherever they want, and properties can charge whatever they want if a resident's willing to say yes. And the number one way to mitigate pushback from your tenants is to have a moderate increase year over year.
Yeah.
Um, when I was renting recently as 3 months ago, the rent would go up $50 a month every year. I wasn't going to move over $50 a month, right? But over 3 years, he was in charging $150 more per month, and that's how you keep a resident in place, and it kind of like slowly walks up over time. And if you have a 5 year horizon or a 10 year horizon on your investment, in the long
Ooh.
run, you'll do better by just slowly increasing the rent.
Oh, and I think that's actually one of your bullet points here about slower deal pace, right?
Yes. Yeah.
Yeah.
Yeah. Slower deal pace is discipline, right? What I think is going to be very hard for us is when we are now looking at property, we are assuming that we're going to buy with stabilized agency debt. So the rate's good, but the requirements are super strict. And our
Yep.
PSAs are going to look different because we're going to maintain that the seller must keep 90 for 90 occupancy and collections and prove it to the agency lender in order to qualify for our debt. Um, that's how we're able to pay for a stabilized property, but we also expect a stabilized asset from day one, which means that it's going to cover its debt service at with 25% or even 30% above our debt service, and that generally equates to 7% interest paid, monthly, quarterly, something like that to our investors.
Yeah. Yeah. And guys, like I think that slower deal pace is a real key here because I've actually, if for anybody who's been paying attention, I've actually been doing like flipping versus holding, kind of an analysis over the last week and a half or so, and you know, I, we've said it before. I'll say it again. I think we got way too much into the flipper mentality for a while there. Like people looked at properties as like, hey, let me raise the value real quick. That caused rent escalations. I got to deploy my capital real fast, and then let me turn around and pull that value out quickly, rather than saying, hey, even if I do that, I'm going to burr it, right? I'm basically going to pull some equity out if I can, refinance it, put it on stabilize, and I'm going to enjoy the fruits of my labor for the next 5, 6, 7 years. Or I'm just going to do exactly what Tim's talking about is I'm going to go in, I'm going to buy right. I'm going to put it on stabilized debt. And the first year it's going to look like 4, 5, 6%. Then it's going to be 6.5, 7.5%. Then it's going to go to 8. And, like 5 years, 7 years down the road, you're stroking a 9, 10% monthly check on that thing. And
Mhm.
and you've had much lower risk all along the way, right?
That's the
Um,
biggest the operational risk and
yeah,
headache of doing fast-paced deals is tough.
right.
I'll say though, I wouldn't I wouldn't change what we've done
No,
because the net worth exploded very fast, right? So,
yep,
you have to grow the equity. You got to grow the balance sheet in order to have cash to invest to create
right,
cash flow.
right,
If you don't have equity, it's very hard to accumulate long-term cash flow because it takes so long.
right.
So there is a level of brain damage you have to go through in order to create the equity, right? Whether it's through a W-2 job that pays you a ridiculous amount of money, through creating and selling a business, through flipping houses or apartment
Yep,
complex or any kind of commercial real estate, you got to go through that phase. And I think what's happening is you and I are kind of transitioning into a little bit of a different phase of our
agree.
investment career of,
Yep,
nah, I'm going to look at this as a 5 year hold. And then 5 years from now, I'll pull my head up and see where we're doing or see how we're going. I do want some level of value add, and I'm
Right.
willing to kind of pay for it a little bit up front, but I'm not talking about $300 rent bumps and, needing to deploy $10,000 a unit. It's going to be more so, these guys are $300 below market rate today. I'm going to do a $150 increase, which is 50% of the delta, or maybe even like a $200 increase, which is, 70% of the delta. And then year after year after that, I'll just slowly continue to increase them in order to get up to market rate. Like I got a 3-year horizon on each one of these residents instead of, when does their lease expire? We got to rip the Band-Aid off and get the market rate rent up.
Yeah. Yeah. And Tim, really good point, because, we talk about this all the time. When you're first starting out, a lot of folks, when they're first starting out, they have, they really have no capital, right? Like, how do you do deals without capital, right? So you do some of these strategies, these more aggressive strategies to create some of that personal capital. And you're absolutely right. As your, let's just call it your bankroll, as your bankroll starts to increase, then you start to look at different ways to do deals to leverage your bankroll differently. Now you've got capital, right? And you're
Hmm.
like, okay, you're like, I'm not looking for fees. I'm not looking for these things. I've created capital. I'm looking to redeploy my capital, have my capital earn and pay me monthly, and then slowly grow over time, or hey, aggressively grow over time if you can. But the key is it's got to pay me monthly as well, right?
Yeah.
I'm, I'm
Yeah.
not
Yeah. Yeah.
just I'm not just looking for that 50% gain in 12 months and get it back. I'm looking for a nice gain over time, and I'm looking for that monthly check in the mail,
Yeah.
right? Yeah,
Yeah. I mean, and that was kind of, that's kind of been the sentiment for a little while now.
yeah, yeah,
And a lot of that discipline has come from the headaches that we've had to deal with properties over the last 12 months.
yeah,
And we went very heavy on the value add. And I wouldn't change it because it's been exciting. It's been difficult. It's been challenging. It's stretched me. Yeah, I'm back and forth whether I want to make a post of like recapping 2025 or not. I really think I should do it, but on
yeah,
lessons learned, wins, losses, all that kind of stuff. But what that has taught us is how to offer something different to our investors going forward.
right.
And the sentiment of investors has changed, and my sentiment has changed. And what that means is I'm probably going to have to rebuild my entire investor base, and that's okay, because I'm in a different place in my life now. Like I don't want to work 12-hour days anymore. I don't want to have to work on the weekends to make sure everything's being solved. I would rather have very systematic approach to things and kind of manage the stress level and also manage the expectations because I think the biggest problem was when the market shifted in the commercial real estate, the expectations of the returns changed as well. And everyone that had signed up 2-3 years ago for the returns we were pitching 2-3 years ago is very, very much not happy because of the change of the commercial market, right? So what smart investors are doing now is they are not over leveraging their deals that puts deals in hot water that could cause capital calls in order to cover your debt service.
Yeah,
They're not banking on appreciation. They're not banking on additional cap rate compression. Uh, the time old saying comes back to me that says, I'm investing for cash flow and appreciation's gravy on top.
yeah. Michael, I kind of like what you're saying here, and I do agree with you. Like, um, yeah, where you are in your journey. I don't mean to sound philosophical here, but where you are in your journey, right? Your ideas, your focus, your goals, they're going to change depending on where you are, right?
Yeah.
And I'll go back to one thing. Like folks have heard me say, like when I started flipping houses, right? I got to a point where I would buy three, flip two, keep one, right? Well, what I always fail to tell people, and apologies guys for that, is it took me a while to get to a point where I could actually do that, right? Like I had to flip a few to create that bankroll so that I
Yeah.
get to a point where I could keep that one, right?
Yeah.
Um, and that takes some time, right? And I think that's kind of where we are now, and you're kind of seeing some other people get as well. Is like, hey, I've created a little equity, I get a little bit of liquidity. Now, how do I deploy my own liquidity to do that, right? To keep something, to maybe buy something that's going to be stabilized up front rather than constantly going in and doing value add. Because Tim, you were telling me about a conversation you had with a friend of ours the other day who also is an owner operator, and it's like, hey man, it's work and it's tiring and it's exhausting to constantly be doing value add, and that is 100% true, right? It's a hundred
Mm-hmm.
percent true. Like, you wake up on Monday mornings and you're like, okay, where am I traveling this week to go check in and make sure that all the guys are where they're supposed to be and those stoves got delivered and that, that drywall got put up where it was supposed to go. I mean, that takes work, right? And then going out and finding tenants to, turn over and move in and do all those things, constantly being in lease and marketing mode, that gets really, really old after a while.
Mm-hmm.
And so, and I'm not saying it's not something we want to do, don't want to do, and it's not something that we're willing to take on. I think it's just, hey, it's nice to be able to look at a few things and go, these are stabilized, these are producing. Let's move on to the next one, right?
Yeah.
Um,
Yeah. It's
because
definitely slower deal pace is the key,
yeah,
right? That I mean that if we could define discipline for us right now is
yeah,
slower deal pace. I mean, we haven't bought a deal since September 2024. I mean, we're going on like I don't know how you're live right now, Tim. You're like,
I'm missing
we've been looking at a lot of
it.
deals and making a lot of offers, but it comes back to the discipline. I mean, as much as I can see a way to kind of stretch a deal to make it work at the purchase price that the broker's
Yeah,
telling me. He's like, hey man, if you come in at this number, it's yours. And I'm like, as much as I want to do that, I'm just not
yeah,
going to.
yeah, yeah,
It's like so it's interesting. Now, the only way I'll preface that with is I can come up to that price, but the seller's got to hold some money back, right, at a super low rate, right, because they're making their money on the sale, not on the interest,
right, right.
and that helps maintain like the cash flow and everything that I need in order to make the deal work. So there's always like a little bit of creativity offered in there as well. Um, but slower deal pace, obviously we've been underwriting to 70% leverage, which is what you're going to get anyways
Yeah,
nowadays. 75 is really unlikely. And it's not because of value, it's generally because of cash flow. So,
yeah,
assuming that, we're going to get 70% leverage, we're increasing our reserves to make sure that this year's taxes and insurance are paid and we're, adequately reserving and putting into escrow for taxes and insurance next year.
yeah,
We're saying no to most deals. I mean, we've looked at a lot of deals over the last year, and we put two under contract. Both of them didn't end up working out. I'm actually kind of thankful that they didn't work out because
yeah.
I don't know if we would have had the capacity to handle what we're handling
No,
right now and those projects we were going to try to buy last April. You know?
yeah. Which, Tim, that's a really good point. I think it really gets you to like one of the things, like learn to say no, right? Like
Yeah,
learning to
learning to
say
say
no.
no.
And guys, like 3 years ago, those deals that we said no to, ultimately, I think we probably would have like pushed real hard to figure out yes, right?
Mhm.
And instead, because we were disciplined, we were more disciplined, we had learned some things, we went in and we were like, I'll do it if this, but if this didn't happen, and we were like, so we're just not doing it. And Tim, hindsight being 2020, um, you're right. I think it turned out to be a very good thing
It
that
was a
we said
blessing
no.
in disguise to do
Yeah,
neither one of those deals.
yeah,
I kind of had said it for one of them. I was like, I don't know. This might be punching above our weight.
yeah,
um, one of the other deals might have been okay, but there's one deal in particular that I just knew was going to take up 100% of time and attention. Um, what are some things that our smart investors are not doing this year? Some other notes that I have, right? So we talked about not assuming rate cap compression. We've assumed not having rent growth for the next year or two. Um, and yeah, I mean the other biggest thing was waiting on rate cuts to save deals. Uh, Sorry, but rates have been cut substantially, and the Treasury yields have stayed generally the same. I know that Trump's been talking about doing like $200 billion worth of mortgage Treasury bond buybacks, which should increase demand and reduce the Treasury yield percentages. Yet to be seen. I don't know if it's actually happened or not, but I haven't checked the 5 or 10 year Treasury this week. Um, but we're not waiting on rate cuts to save deals. We are trading out debt when we can, locking in long term debt, making sure that there's cash flow and appreciation there, and looking at it on a longer term horizon. So if you're new here, if you're new, not new here to the group, but if you're one of the newer investors, some bullet points that I had for what new investors should take away about some of the experiences that we've had, and um, how we're pivoting our business model and mindset and all that kind of stuff is, you don't need to be brilliant to buy a deal. You just need to be disciplined, right? And
Yes.
what that means is you got to understand your market. You have to understand what your criteria are, and you have to learn to build your network and trust your network of people to rely on to say yes or no to a deal. And if somebody says no to a deal and you are sitting there trying to figure out yes, you probably fell in love with it,
Yeah.
and it's probably not a good idea to do that deal anymore.
Yeah. And Tim, I got a question for you. Would you say if you're new in this market, kind of to Michael's point, like where you are in your journey, look for a more vanilla deal. Like
Hmm.
look for something that's a little more straightforward. Don't try to get too creative on your first one. Would you
I
agree
think
with
I don't even know if it's getting too creative. I think it really comes down to leverage. Don't
that?
try to get over leveraged on your first deal, right?
Well, for sure, for sure.
Don't try to get rich on your first deal. Uh, Modest returns over the long run will outpace, the boom and bust, right?
Yeah,
So having an expectation of lower leverage, safer returns, really analyzing in-place cash flow,
yeah,
and having a really solid idea of what your expenses are going to be on a going forward basis is going to protect you first and foremost. And for your CapEx budget, you probably want to bump it up 25%, right? To be safe.
yeah.
If you don't need the money, great. You can return it to the investors, or maybe never draw upon it from the bank, but always request more than you think you might need, because there's a lot of stuff that comes up along the way.
Yeah. Yeah.
Um,
Yep. 100% on that. And the one other thing I would add to that is, another reason to get in and do it that way is, I think it starts to teach you, I guess I'll use a bad word here. I guess it starts to teach you what you're willing and wanting to do as well. Um, you
yeah,
follow?
as a new investor though, I mean, I know what I want to do, but
Yeah.
you kind of have to be willing to do what you don't want to do for a period of time so that
And
you
I,
can do what you want to do.
and I think that's a key for a lot of people, right?
Yeah.
Is people think they want something and then you get into it and you're like, I really don't, I'm not willing to do this. Right.
Yes.
So I think
Yeah.
that's part of what comes with experience too, guys. But yeah, Tim, I'm 100% with you on that, especially when it comes to like, adding that extra capex in there, not waiting on rate cuts to do things for you. And then I think the biggest one, right, is other than over leveraging, is assuming like this great appreciation, because a lot of folks that assumed cap rate compression are really, really crushed right now, to be honest with you.
Yeah, and what we're not saying by that is you can still force appreciation on a property if you buy it correctly and you
Right,
increase the rents to market rate. What we're not saying is that if you're buying a property, you can expect the property values to skyrocket just because
right.
you've held a property. So forced appreciation still happens if you're buying under, if you're not overpaying for an underperforming asset. That still holds true.
And if your timeline, if you got a long enough timeline,
And you
right?
gotta right, and you got a long
Because
enough
because
timeline.
because to your point, at any given time, you can go raise your revenue, your top line revenue significantly, but your value may not rise,
Right,
right?
and that's what I was talking about recently. Was somebody was commenting on, like 2025, and I was saying how 2025 was difficult for us because we executed our value add plans, and we got the rent rolls to where we wanted them to be, and we reduced our expenses where we could, but because of the cap rate decompression and the increase in property taxes and insurance, we executed our value add to increase the value, but then that value was wiped out by the increase in the expenses. And it's not to say that we weren't successful. It's to say that we did what we needed to do in order to stay in the game. Because if
Yeah,
we didn't execute on the business plan and then all of those things happened, we would have missed the mark, right? So being able to execute the business plan, even though the equity was wiped out, is still a win because you're able to refinance out your debt, and then you can ride it out and wait for the value to go back up over time.
Do what you got to do to stay in the game.
Yeah, right.
If there's anything to take, man, those are some wise words right there.
Yeah. So Dennis says, are you still buying LIHTC that is close to its end or looking at things that have a longer use period? We we're, we're still looking at both. Honestly,
Right.
we are looking at some newer build stuff that's in the initial compliance period. We are looking at some stuff that's coming out of the compliance period. We're looking at market rate properties. Yes, we kind of specialize in LIHTC, right? Because not a lot of people do it, so we specialize there, but I won't say no to a market rate property.
Yeah. And then Dennis, I also would say, um, if my time horizon's 7 years, I'm very, very happy to buy a LIHTC property that's got 5 years left. And then
Oh, absolutely.
I got 2 years of market rate before I start to think about selling. I'm 100% on board for something like that.
Yeah.
Um,
Yeah, I
yeah.
think the patient investor that buys a deal that has LIHTC restrictions that comes out in 5 years, I mean, it's a surefire way to make a killing
Yeah. As long
because
as
you just
you
gotta
buy
be
right. Yeah.
patient,
Yeah.
right? I mean, Tim and I own a deal that comes out of LIHTC in a couple of years, and the valuation literally went up. Hold on a second, let me do the math. From like $70,000 a door, and in 2 years, it'll be worth $125,000 a door.
Yeah.
Just by waiting, by doing nothing significant, just keeping it full. We don't even have to increase rents. Just keep
Nope.
it full, keep it stabilized. Just let it hum for 2 years, and then when it comes out of LIHTC, then you can start looking at selling it. By doing nothing, because we bought a LIHTC property, now it's a market rate property with no restrictions. You opened up your buyer pool significantly. A lot more people are looking for market rate, and let me tell you, those value add guys are chomping at the bit to buy something with the rents that are $500 below market.
Yeah. Yeah. So yeah, I mean, Dennis, the answer to your question is yes. It's really all about deal metrics and not as much about the specifics of the asset, right? If you will.
Yeah.
So yeah.
Yep. All right. And the last thing that I wanted to make sure that we told people for new investors that they should take away from our experiences is that you need to get the reps in at the end of the day. I mean, underwriting deals, talking to your network, trying to figure out how to do things differently, to be a little bit more creative, a little bit more uh, trying out new underwriting models. I'm actively doing that myself. I've taken some advice from people that I've met on Twitter and applied their business model. I've used our old business model. I've used seller financing models. I look at deals like maybe 5 different ways now to try to see what's going to be the best way for the deal to work and what is going to benefit me and my partners the most. It's a blend. I don't know everything. I mean, Tim and I will talk about a deal for an hour and still, find holes in the thesis or find holes in the structure. And then, you can never predict what a seller is going to be willing or not willing to do. So, kind of shooting your shot and seeing where you can get a deal to land, but taking a look at it with multiple different structures and mindsets and trying to figure out what's going to be the best scenario for this specific deal in your investors or yourself. I mean, if you're buying it yourself. So, all right. With that, that's all we got for today. That's why we think discipline outperforms genius and what smart investors are not doing today. So appreciate everybody joining and for the comments and everybody watching live and watching this later. If you have any questions, post on the video and do my best to answer all the Facebook comments that come through. So appreciate you guys. Peace.
See you guys. Bye.